Good morning. My name is Adishan Naidu, and I'm from the Global Markets Retail Investment Team. I'm once again joined by Executive Global Markets Trading, Tom Gale. Tom, thank you so much for your time this morning.
Hello, Addy.
Well, let's jump into it. This is the market pulse, and let's know what's pulsing this market. I mean, there's a lot going on. What can you bring the listeners today, Tom?
Yeah, okay. Well, let's start with some faces. And most of your audience will be familiar with at least some of them. They're all going to be important this week. Donald Trump, President Trump, is always important, as we become accustomed. Bottom left is the Federal Reserve Governor, Jerome Powell, pictured with Donald Trump. He's been under some pressure to cut rates. Donald Trump has been quite insulting, actually, of the Fed chair. We'll come on to that in a moment. The picture top left, Donald Trump pictured with committee member Cook, and she has also been under some pressure.
A lot of news around her and scrutiny around her at the moment.
Yeah, I don't know if we want to go into a deep dive on this right now, but what I do just want to plant as a thought is that we've all lived for the last couple of decades with the understanding, the sacrosanct understanding that central banks do their job unimpeded. They're independent institutions, and there should be no political interference. What's been going on in the US has broken with that tradition. Donald Trump has been trying to force out, in fact, he fired Lisa Cook. She has a stay of execution because she's appealed the ruling, but it's clear intent by the Trump administration to bend the Federal Reserve to its will, and right now that could be positive for markets. I would argue further down the line it's quite negative. It's positive in the short term because, of course, if the Fed bends to pressure to start cutting rates, maybe when they have other concerns like sticky inflation, well, the markets will cheer that for now, but further down the line, mixing politics with monetary policy has in the past, in history, created some boom and bust in the business cycle. So let's just keep that to the back of our minds. The other important person this week, of course, is Lesetja Kganyago, because not only is the Federal Reserve due to meet and announce on policy this week, but so too the South African Reserve Bank.
100%. Those are some really good images, though.
Right. Well, we start with people and then we move to numbers and data.
Exactly.
The US curve, rates curve, traders who bet on rates are firmly behind the Fed cutting rates on Wednesday by 1/4 of a percentage point. So 25 basis points. In fact, rather oddly, the rates market in the US has 26 basis points of cuts priced. So in other words, that tells you that the market is certain that we're going to get the 1/4 point. And then there's a long shot, an outside chance that we'll actually get 50 basis points of cuts. I think the broad message here is that we are fully priced. Yeah, the markets are expecting this cut, and we better get it, because if we don't, there'll be a bit of disappointment. I'd actually argue, if you follow where I've circled in red a little bit, just follow the column downwards, you can see that there are further cuts priced. So in fact, by the end of 2025, the market is expecting that the US Federal Reserve will have cut rates by 70 basis points cumulatively. In other words, that's almost 325 basis points cuts. And in fact, follow the column further out and you'll see that there are more cuts coming in 2026. So there's a lot of expectation of US cuts, despite stickiness in prices, as I say, courtesy of some of that of tariffs and other influences.
I think on that though, Tom, just to pause you there, I mean, it's priced in the cuts, but you mentioned something quite important. The market's priced in for this. If the cuts don't come, I mean, what could be the adverse that we could see unfold or unravel? if you don't mind.
Yeah, sure. So as I alluded to, there's quite a lot now expected, and as you say, if we don't get the cut, or if we get the cut, but the Fed then signals that it doesn't want to cut aggressively, well, a big sharp repricing of this curve would impact equities, and we would see a sell-off in risk assets. So that remains a distinct prospect this week.
Okay.
So I want your audience to have that at the back of their mind, that to squeeze much more out of this, we need a very dovish Fed. So there's almost an asymmetry to this. The Fed needs to deliver as the market has demanded, or there could be a bit of disappointment, to your point. But I don't want to spend all our time talking about the US, because I actually would like to, first of all, consider what Fed cuts, whether it's this meeting or the next meeting or whenever it comes. Well, what does that mean? And then what does it mean for South Africa? The first thing I'm going to talk about here is gold. And actually, this is a slide that we may have referred to in the past. And it's, well, first of all, a slogan courtesy of our gold analyst, Adrian Hammond, who sits in our Standard Bank Group Securities research department, and he's been saying for a while, for a few months, that gold will keep going to $4,000 an ounce. And what I've done in the chart here is overlay the gold price with in blue, with in white the US market's expectation of rate cuts, which, say that's inverted. So the more that the market prices US rate cuts, the higher the gold price goes. And really that relationship on a very simplistic level is because that means that if the Fed cuts rates, that means rates and real rates adjusted for inflation come lower. Good news historically for gold, because gold is a zero yielding asset. So often gold is having to compete with other assets that pay interest. Well, if those interest rates are not as high, then that's good news for gold. So with the way that the US market has been pricing US rate cuts, that's been good for gold. And of course, gold is something that we produce here and we sell for dollars. So I'm going to come back to that point in a couple of slides. Before then, I just want to contrast what the South African rates market, South African-based traders are pricing into the South African rates curve. And I'll draw your attention to the green column in the middle. And those of you who became accustomed to reading the Fed Fund futures curve a moment ago could extrapolate that what we're saying in South Africa is that we, with our own Reserve Bank meeting a day after the Fed, that is therefore set for Thursday, is not going to cut, or at least we're not positioned here in South Africa for as aggressive a rate cut. So 11.7 basis points is, roughly speaking, Adi, forgive me if it's not precise here, but roughly speaking, a 50% chance of a 25 basis points rate cut. It's almost half of 25, okay? And in fact, follow the column down and you'll see that all the way out to the middle of next year, the South African rates curve prices only 40 basis points of cuts. In other words, less than 2 cuts of 25 basis points. So this is in stark contrast, if you remember, to that US rates curve, and you can see that where I've got US pricing to the right of the green column.
Yeah.
So why are we not cutting as much?
Ask that question because it's almost like if we correlate and follow majority of what happens in the US markets from an equity side to our equity side, why wouldn't we follow here? I mean, if their Fed is cutting, light bulb will say we should follow suit.
We should follow suit. The relationship is not always a 1-for-1. It's not what we would say is a 1 delta relationship. Actually, if the Fed was hiking, for example, then South Africa would be normally expected to hike more than the Fed, and of the Fed cuts, we'd be expected to cut less than the Fed because of the the structure of the South African market and the economy here and so on, and the way that the rand is considered as a volatile emerging market currency. But nevertheless, we would argue here in the trading room that we should be cutting more, and there are a couple of reasons, which I'll come on to. I do just want to perhaps offer one explanation of this very shallow cutting curve for South Africa, and the first is to say that, well, there are competitor banks in South Africa who argue that there will be no cuts until next year, no cuts for South Africa. And just let me just repeat that, none, no cuts. But actually, there are also competitor banks in South Africa who see a lot of cuts. So it's very rare that you get a very polarized debate around what South Africa should be doing. So I think that partly the rates curve in South Africa is confused. There are some pricing no cuts and there are some pricing a lot of cuts. And so the curve gets stuck in the middle somewhere. The other reason is that the Reserve Bank has very publicly announced its desire to see inflation targeting of 3%. Historically, it's been 3% to 6% as a range, a band. The Reserve Bank wants to go to 3%. And if you're going to do that and force inflation lower, you need to just hold off on the cuts. The question then is, well, is that the case? And is that the case for this week? I'm going to argue, we do argue here at Standard Bank on the trading floor that we will get a cut this week. That's our guess. We're going to get a cut. By the way, I just need to be clear here to you and your audience. Elna Moolman, who's our economist, is a very accomplished individual and far smarter than me. And she thinks that on balance, just on balance, that we won't get the cut this week. But she is even acknowledging herself and conceding that there may be one. Well,
so let's ask this point, right? There may be a cut. And to your point, and you kind of alluded to this, when the US kind of hikes yields, we almost double up. When they obviously cut, there's possibility that we won't, and you show that now. But I mean, you've also stated that the US may, and there's a small possibility they may cut 50 basis points. So if a 50 comes in, there's almost a guarantee we're going to cut 25. Is that kind of the thinking around it, right?
Not a guarantee. There are no guarantees in markets nor in life, Addy. And what I would say is that, you know, we've got a very different set of problems that we're dealing with here. So there's no guarantee. But I want to just say, in terms of probabilities, well, yeah, I would partway agree with you. If the Fed is cutting, that allows us to cut because rate differentials are not so, not working against us so much. And another piece of evidence that I might submit here is the chart that you're looking at now. It shows inflation expectations in South Africa. And those inflation expectations have been coming lower. So actually, the Reserve Bank could easily argue that, yes, they want to target a lower inflation rate. And yes, that may mean that they have to be a little bit meaner in their rate decisions. But right now, inflation expectations, what people expect inflation is going to be in the future, is really under control. And so that's one problem solved for now. The other thing is that Lesetja Kganyago has actually told people in public presentations that inflation right now, due this week, by the way, we've got inflation coming out, CPI on Wednesday. It's going to print a little bit higher, but Kganyago has told us it's going to be temporary. So it sounds like the Reserve Bank here is broadly comfortable. So let's see. I think certainly things are set up nicely. Oil has not been a problem for us. The gold price and platinum prices have been good. Inflation expectations are coming lower, as we see here, and so there's really a set of parameters that mean that there is the opening, the opportunity for the Reserve Bank actually to cut. I talked about gold. I've talked about the rand behaving. The rand in blue is inverted, so the higher it goes, the stronger the rand is, and you can see that it's following the terms of trade, South African terms of trade. It's a slide that we've used in the past. In terms of trade, we export gold, we export platinum, we import oil, and that differential has been favorable for us. We're earning more dollars from higher gold prices, and so the rand is very steady. You and I have been talking about the rand over a number of these
100%.
sessions. Through the market pulse, we've been saying, well, the rand is good, the outlook is good, and we're now down through 1750, and we'll keep going. Probably 1720 will be the next support level, and
Yeah, I
then
think it's
17.
1734 at the moment.
Yeah.
So yeah,
Well, it's conceivable then that we'll head down through 17 in the near future. Although if we get a rate cut this week, you'll just see the rand weaken just temporarily.
slightly. But I mean, Tom, to that point, and I mean, I just want to highlight and the listeners that are on the call listening to this and will be paying attention to this when and unpacking this. If a Fed cut comes in, there's a huge correlation to U.S. Fed cut in that sense to gold. Our Fed cut, what can we see in terms of a correlation? Are we just going to look at USD, or the ZAR in this instance, or what more can we see?
Okay, well, assuming the Fed cuts, assuming then the Reserve Bank, the SARB cuts, we'll see on balance, because the South African decision is a little less priced, it's a little more doubtful. Yeah. So I think we'd at the margin see the rand a little bit weaker, but the dollar remains a weakening currency, and so we still feel very constructive. If you do see dollar rand go a little bit higher at the back end of the week, it will then come lower again shortly thereafter. Okay, I want to just remind you and your audience that South African bonds have been performing very strongly. This chart shows you the yields of South African government bonds coming lower. That means our borrowing costs have been coming lower. Your audience who may have listened to previous sessions of the Pulse might recall a very different looking chart for countries like the UK and France and so on, where borrowing costs are going higher. So South Africa right now has its house in order. Doesn't always feel like it when you're driving to the office or on your way to see friends at the weekend. You see a lot of signs of collapse and so on. But actually, the backdrop really at an economic level, a very high level, which takes time to feed through, has been far more constructive. And we know from data that the foreigners have been buying our South African government bonds. They're really buying into the South African story in a big way. Not in equities yet. We're still waiting for that piece. It's been a long absence, but they've been.
I think you said that in previous pulses too. We're waiting to see that flow from foreigners in equity markets.
Yes, so that's still to come, and we can debate that another time. I would just like to say, though, even without the foreigners, the JSE has done very well. You and your audience will be familiar with the performance of the all share, or the top 40 in this case. I've got the top 40 here in the left-hand chart in white, and it's in dollars, and it's normalized. That is to say that I've taken a starting point of 100 last year and overlaid with the S&P. And you can see then that since last year, the top 40 in dollars has returned 33%, and the S&P has returned 17%. So let's just take a moment just to remind ourselves the JSE has outperformed in hard currency the US. And in fact, if you take the chart from April this year when we had that sell-off, and in fact, I think we spoke about this at the time, we said, well, we're not feeling great about the US and the risks remain. We thought there might be more risks in April and May and so on. We still think there are risks to the US, but the JSE still very cheap. We're still very cheap, and there's value here. Oh, and you and I spoke about this. It might have been last week or
2 weeks ago.
Okay. Okay. Well, I just want to remind you and your audience, yes, even with this big rally that we've had to record highs, South African stocks remain cheap. And Adi, if we do get the rate cut this week, the stocks that have been left behind should do a bit better. And I'm thinking retailers, for example.
Okay.
Anything that's consumer related should do a bit better when we start seeing rates
above our miners, right?
cut.
So over and above miners, where it's natural because we're an exporter of gold. So if the US cuts, we see gold, as you said, would go. So our mining stocks would naturally increase. If our cut comes in, we see over and above our mining stocks, we would see value in retailers, you say?
Yes. Well, let's just remind ourselves again. This was a slide I think that we spoke about a couple of weeks
Yes.
ago. But our top picks from the research department. This is our institutional research coverage team in Standard Bank Group, our broker. So we're not telling your audience to go out and buy these, but we're showing how we rate these stocks. And I think we mentioned last time that there's value in the retailers. The retailers have not been performing this year, to your point. Miners have done all the hard work, and miners can still keep rallying, of course. But if we do start getting rate cuts, well, we might see buyers, institutional buyers, start to come in for the retailers as well. And I'd highlight, for example, for Sheeny Group, there's some upside to our price target. Same for ShopRite and Pepcore. Especially with the effective Steinhoff overhang now out the way. Also, there's some value there. Clicks we've always liked, and Dischem too. So there's some value in the retailers, but it's certainly been the case this year that the miners have dominated, and more recently Anglo American has been in the news, first of all, just recently for its sell down of its holding, what used to be called Amplats, Anglo American Platinum, has since renamed to Valterra. And Anglo American exited its holding of Valterra, as it said it would do, selling down the last of its 20% in that one. On the right, in fact, I've got the chart of Anglo's share price against Valterra. Both have done well. Both have done very well. You can see that. On the left, I've got the share prices of Anglo American in dollars and Teck Resources in dollars. So Anglo American and Teck Resources have announced a tie-up, a merger of equals, they call it, although Anglo's would effectively make up about 2/3 of the market capitalization of the combined group. And it's actually a very smart move. It's a very smart move by the two groups. Anglo's, especially because, of course, Anglo's is trying to fend off predators, would be acquirers. There we go. Yes. You remember the approach from BHP last year. So this is very smart, but it makes sense, from a shareholder point of view, because there are lots of synergies, cost savings. Both Anglo's and Teck have copper assets that are very close to each other in South America, and they can squeeze out cost savings there. So it makes sense. What's interesting, if you can see the little insert top right, and excuse the messiness of the of the numbers here. What I just want to draw your attention effectively to two grids. The first is where Teck US is trading at a premium against the Anglo terms of just over 4%, and bottom right, the US ADRs. Again, 2.5%. Without getting too caught up in the detail and the numbers here, it's interesting that Teck is trading at a premium to the Anglo's offer. Once you adjust for a special dividend that Anglo's would pay to its shareholders prior to completing the merger. So what does this say? Well, it's telling us that the market expects that this is not the end of the saga, that actually other mining groups could come in and try and bid over the head of Anglo's for Teck. So I think that this story has some way to go. We haven't heard the last of this yet, but in the meantime, and we've been saying for some time that Anglo's itself cleaning up its portfolio, selling its platinum assets and simplifying it, still to sell off its holding of De Beers, for example. As it gets simplified and as it concentrates on its on being future ready with its copper assets, whether it's through merger or not through merger, well, Anglo's starts to look it continues to look very appealing. So Anglo's and the miners more broadly, I think remain a good space. But this week is going to be about rate cuts. Let's see what comes of it.
Perfect. Well, thank you so much, Tom. I mean, that sounds there's a lot to digest, a lot going on, and after I think Thursday we'll have some clearer direction, and looking forward to what insights you can bring thereafter on Monday. So thank you so much, and have a great day.
Thank you.